Hello, everybody. It is a beautiful Friday, and welcome back to, of course, another workshop. I want to see how everybody is doing, so please leave a comment in the or leave a comment below, subscribe, do all that fun stuff, like everything like that, so I can, make more. Even though I'm going to make more regardless. But today we're talking about investing, retirement, and planning for your future. So, a little icebreaker. You can also leave this in the comment if you want to. Has anyone here ever made an investment? If so, what inspired you to do so? And if not, why? We'll get into more into what defines an investment, and then you can leave that comment after the video. So, definition: what is investing? Putting money to work for a period of time in some sort of project or undertaking in order to generate positive returns over a longer period of time, i.e., profits that exceed the amount of the initial investment. It does require some sacrifice, either time, money, or effort, and of course, purpose is to generate a return from the invested asset. So you want to make a gain when it's an investment, or else it would be a bad investment. But investments are investments. So, reasons to invest: make money on your money, achieve self determination and independence, leave a legacy to your heirs, and support causes important to you. And then we can talk about compounding interest really quickly, just because it's a little tidbit. The power of compounding interest, which is it earns money on principal, continue earning interest on already accrued interest, etc. Or, basically interest on interest. And then your money will grow exponentially. So those are some reasons to invest, because of those benefits of essentially just making more money and making a better environment for yourself. All investments don't have to be monetary. The ones we're talking about today are, but in general, we've been talking about investing in yourself way back since September. So this is just a monetary way to do it, but of course, investing in yourself comes from taking care of yourself. It comes from feeding yourself. It comes from enjoying your time spent. These are all investments into the way that you want to be in the long run. But this is just the monetary part today. So investing is an effective way to an effective way to make your money work for you and potentially build your wealth. So, what is the stock market? Because when a lot of people think about investing, their brain goes immediately to the stock market. So, what is it? Stock market is a collection of markets and exchanges around the world where public companies are traded and sold. Main regulators are the Securities and Exchange Commission, and then financial industry regulators. Authority is it allows companies to issue and sell shares to the public. It helps companies raise capital. Companies pay a fee to have access to the stock market. So I don't know if you've ever seen this before, but I've seen these on like TED Talks and YouTube videos and Twitter, social media in general. You'll see these people come up on this big stage and they'll be introducing their company. That is them taking their company public. And when they take their company public, it means you or any investor or any individual can now buy a portion of their company, essentially like a stock or a share, and now it makes them almost part owner of that company. And the true owners of this company, do this, like we said, to raise more money and to be able to make these gains and to be able to make these advancements in their companies. So next up, we have types of investments. So you have types of investing for the future. You have the stock market, you have property, and you have businesses. Investing differs from savings in that there is some implicit risk that the related projects may fail, resulting in a loss of money. So let's talk about the types of investments really quickly. So we have bonds, which are a loan to a company or government that pays investors a fixed rate over a return of a specific time frame. It's very low risk, but it also is low reward depending on how much money you put on it. Next, we have stocks. You own a share or a small piece of a company. If company performs well, you will receive a dividend. It is high risk, but it also is high reward. Then you have mutual funds, which is a pool of money from investors, combination of stocks and bonds chosen by an investor for the mutual fund, less risk than individual stocks. And then you have ETFs, which allow investors to pool their money when investing in stocks traded on national stock exchange market prices. This is definitely for your more advanced investor, but it is something that you can do. So let's dive in a little bit more of stocks versus bonds, because when you think about investing, initially you are going to go to these two. So stocks, purchasing a tiny slice of a company, one or more shares. Technically, you are now a partial owner. So the more shares you have in a company, the more you own in a company, and the more money you could make, or the more money you could lose. Companies issue shares to raise cash to fuel growth. If a company performs well, the value of your share grows. And so to earn money, you must sell your share, and the capital gains will be taxed. High risk depending on company's performance, potential for higher returns. Average annual return is about 10%. So stocks are something where you put in money and you pray that it makes you money back. My tips for stock is there's different ways to go about it. You never want to make your stock be super high priced. So like, you just don't want to invest in a stock when it's super already high, because you're probably not going to be able to make just as much money as you could with it being a little bit lower. So you buy low and you trade high. That's how you end up making your money back. But it's important to know what you're investing into, because the stock market is changing all the time. It changes every single day. It goes up and down. So those that are really committed into investing, that make investing their sole career, they're literally studying it every single day, up and down. But for those that maybe do investing on the side, or investing as just like a thing to try out, make sure you're choosing to buy a little bit on the lower side, just so you give yourself the better opportunity to make some money back. And also do your research with who you're investing in, because that is the most important thing. Know what you're putting your money into. Why? Because you want to make your money back, right? Next, we have bonds. Bonds are a loan from you to a company or a government. When you buy a bond, government pays you interest for a set period of time. Usually, you know exactly when you're signing up for, and you can receive regular interest payments. You can purchase different durations of bonds, earn money through interest payments, lower return, average 10 years, total return of 4.76. So that's on the lower side. Government bonds and bills are virtually risk-free. Corporate bonds, there's varying risks, simply because in a corporate company, it could go either way, and you may end up losing your money, even though it's less of a probability than with stocks. The thing I do like about bonds is they are very secure. The thing I don't like about bonds is you might not make that much money from them. But it kind of depends why you're choosing to go this route. So somebody that maybe has a long-term plan, you're not going to do anything for about 7 to 10 years, maybe 5 to 7 years, something longer, then that's where a bond may be a better option, because then you can put your money in it, let it grow, and you're going to be making back. Like, guaranteed that there is a money that is going to be coming back from you. Next, let's talk about mutual funds and ETFs. So the similarities are they're structured the same. Both represent a mixture of stocks and bonds over diversification of investments. ETFs do not require a minimum initial investment. Purchase an ETF for the price of one share. Implicit and explicit costs may include trading costs and tend to be more tax efficient. Mutual funds are managed by fund managers, require a flat dollar amount initial investment, no trading commissions, but may carry other fees. Consider mutual funds if you want to make regular monthly contributions. So essentially, they're a mix of like stocks and bonds, as we said. ETFs tend to be a little bit more friendly for you to start on your own, but in my opinion, they do require a little bit more research, because there are a lot of benefits to it. Mutual funds, they do require a set amount of money to begin, but most likely you will have somebody to kind of support you in that process. So it's something that you can participate in, but I would participate in it, one, if you have the time and patience and are willing to learn everything, the ins and outs about it, and also if you really just have the time and the patience. That's the main thing. In general, I do like stocks and bonds more because they tend to be a little bit more user-friendly when beginning, but mutual funds are very popular, and if you're interested in multiple things, I love mutual funds just because it's a mix of stocks and bonds, and there is some security with that. So let's talk about ways to invest. So we have self-directed, and requires a fair amount of education, skill, time commitment, and the ability to control one's emotions. Start by researching types of funds that you may want to invest in. This way, do your research. That's the most I can say, is definitely do your research, because it's all on you. And I want to make sure you guys are making smart decisions with investing in your money. So do your research and ask your questions. Now we have professionally managed. This is what we were talking about a little bit with the mutual funds. So these people charge their clients a percentage of their assets as their fees. So when you make money back, let's say you make $500, they're going to charge you a little percentage out of that $500 as their fee. Confirm that your investment professional is licensed and registered. Why? Because it's your money and you want it to be secure. Professionals make the decisions of where, how to invest for you. This is the risky part. You want to know that the person that is working with you and investing your money is licensed and registered, and you want to make sure that they're doing a good job. You want to make sure this person knows you, knows what you want to do, and you guys share the same vision. Now, lastly, we have the robo-advisor, which is powered by algorithms and artificial intelligence. They gather critical information about their investor and their risk profile to make suitable recommendations. They offer a cost-effective way of investing and can also help develop retirement plans and manage trust in other retirement accounts, such as 401ks. This definitely seems like the easiest route, but again, technology is a hard thing to understand. So if you're not that technology savvy, then I probably would not go with this robo-advisor. But if you know how to do technology, you know pretty much how things generally operate, then this might be a good option for you. Things to consider before investing. So one, your future financial situation. You want to know where you're going to be, so you know if this investment is a smart thing for you to get into. Two, the risks involved. You want to make sure that there's not as many risks in your life when you're jumping into an investment, just because you want to make sure you are stable. So guys, I don't want you going and investing when we need to worry about rent, we need to worry about groceries, we need to worry about these other things. Invest when you develop your savings and when you have a developed plan for your future to come. So maybe when we're done with our program, that might be a better idea as far as investing when it comes to at least the stocks and the bonds and things like that. Of course, think about your potential returns. If the investment is worth it, and I mean really, really worth it, then think about the reward that you could get from it. And then, of course, think about the cost involved. Of course, it always takes money to make money. So think about what you're putting into it and what you're going to get out, and make sure that it at least equals out, because, again, I don't want you guys losing any money in this. No matter what you're investing in, there will always be some risks. So definitely, know what you're getting involved in. So, popular investing firms and apps. So, first, for firms, Vanguard, Charles Schwab, TD Ameritrade, E-Trade, and Fidelity. I personally have Fidelity and Charles Schwab. I've worked with them, so I definitely do suggest. And then for the apps, we have Fidelity, Robinhood, Investment Acorns, and Stash. For me, Robinhood is a super easy app to understand, so I'd be happy to talk to you about it. But those are just some apps and things to get you started for when we're more thinking about it. Of course, we have some general tips on investing. So the younger you are, the riskier you can be with your investing. Not that I encourage it, but you can be, just because generally you have some time to figure it out. Of course, don't stress over short-term movements in the market. More important to track overall trajectory. So like I said, stocks and bonds, stocks, they fluctuate every single day. So what you're looking for is that longevity. You want to make sure over time that your money is steadily increasing upwards, so that in a point or a certain amount of time, you'll be able to go and say, oh, hey, okay, I want to sell this now, and it should have made you money. Resist the lure of low-price stocks. So there are such things called as penny stocks, and sometimes those can be a trap for you, because they're so cheap and they're unregulated. So it's very easy for you to lose your money, or at least make sure you do your research on the companies that you're investing into. And then also, don't let tax implications stop you from investing. Achieving high returns is the primary goal, but do be mindful. I will say that. All right, so now we're getting into retirement. So what is planning for a retirement? The process of setting goals for your retirement years and actions and decisions needed for achieving those goals. Identifying sources of income, estimating expenses and cash flows, implementing a savings program, and managing assets. So for those who have any questions, I want you to drop a question that you have about retirement in the description box. Or if you already know what you're doing for retirement, let somebody know. Give a tip or give some advice on what you did to prepare you for this stage. So the importance of planning for retirement. things to consider. Retirement planning is what can help you to be financially comfortable after you leave your job. Relying on Social Security to cover the majority of living expenses can be risky. Many get by without ever making and executing a retirement plan, but those who most enjoy their retirement plan do so in part due to having a retirement plan. Retirement planning will help you avoid running out of money in retirement, and those are all great reasons to plan for retirement because, like everybody has talked about at one point, retirement is supposed to be the most fun time of your life, and we want to ensure that for you. So it takes time in planning and saving and making sure that it will be. Of course, they do have Social Security, but like I said, you can't rely on it because their government is always changing, and certain things, certain policies are always changing. So it's on you to make that security for yourself. Why plan for retirement early? Because we want to retire, in short, but prepare for unforeseen medical expenses. Things like that happen. Safeguard your financial independence. You know you've been working so hard, it's time to protect that. Maintain a good standard of living. You've also been working so hard, and it's time to maintain that. And of course, there are tax benefits and a better return on your savings. Let's see. How much money do you need to retire? Now, this depends on everybody, but essentially, you estimate your annual living expenses in retirement. So, follow the rule of thumb that a typical retiree needs about 80% of his or her pre-retirement income to maintain the same standard of living after leaving the workforce for good. So, what I would do is the monthly budgets and the monthly income that we do together. After those expenses that you get, kind of multiply that by 0.80. That way you find what 80% of that is. When you get that number, that should be around, like, that would be your cost of living. So you need to make sure your income is above that cost. You subtract your expected Social Security benefits from any pension income you expect to receive from your estimated total annual living expenses in retirement to compute your estimated net annual living expenses. Consider reviewing your latest Social Security statement, which you can find on the Social Security website. And this has an estimate of the Social Security income you are likely to receive based off your tax information. Multiply your estimated net annual living expenses in retirement by 25 to determine the total amount of money you need to save for retirement. The rule advises you not to withdraw more than 4% of your retirement savings per year in order to fund your retirement for at least 30 years. So if you, come on, we can do this, guys. So let's talk about Social Security benefits. The Social Security retirement benefit, a monthly check that replaces part of your income when you reduce your hours to stop working altogether. Only replace some of your earnings when you retire. It develops a qualifying disability or you die. Your benefit payment is based on how much you earn during your working career. Your higher lifetime earning results in higher benefits you are eligible for. If you are 62 or older, or if you worked and paid Social Security taxes for 10 years or more. So your Social Security, some of you are already getting this money, but essentially it is paid out to you from the government, and it is defined by how much you worked beforehand. So for those that have not retired yet, continue to work, continue to make your money so you can make it up for yourself later on. It is the time to go hard or go home, because you want to be able to kick back, relax, and enjoy your feet in the sand whenever you want to. And that comes from, of course, planning ahead and making sure you're putting your best efforts, not only now before we get to this point, but all the time. So, types of retirement plans. Retirement plans provide tax advantages to encourage you to save for retirement. Different types of retirement plans vary in the kind of tax benefits they provide, as well as in contribution limits and withdrawal rules. Some retirement plans are designed for employees, other for business owners or self-employed people, and some are eligible to anyone. 6 of the most common types of retirement plans are 401ks, traditional IRAs, Roth IRAs, SEP IRAs, simple IRA, and simple 401k, and then solo 401k. So I'm going to let it sit here so you can see what the difference is. So we have 401k plans. A 401k plan is a retirement savings plan offered by employees that has a tax advantage for the saver. Percentage of paycheck paid directly into an investment account. Choose between investment options, usually a mutual fund. For 2023, the limit for contribution is $22,500. Ages, I want to say 59 and under, but I can't really see it. Yeah, 50 and under. And then you must be 59 and a half to avoid penalties for withdrawal. For the traditional 401k, contributions are deducted from gross income. So before your taxes, taxable income is reduced by amount of contributions. Taxes due when employer withdraws the money, and it's more common offering from employers. So when you go to your employer and they say, hey, we can set up a 401k for you, it's probably going to be this type. So then you have the Roth 401k. This contribution is deducted after tax income, so there's no tax deduction in the year of contribution. No taxes are due when the money is withdrawn because that money has already been taxed. I typically like this one a little bit more because the money has already been taxed and I don't have to worry about it changing, but it kind of just depends because when it comes to like taxes, sometimes the percentage amount it changes. So like I could go back and forth between these two, but both are great because why? They're saving money for you later on. Next, we're going to talk about IRA plans. So individual retirement accounts. So it's a long-term savings account. It's a good option for self-employed, and you can choose to invest in stocks, bonds, ETFs, or mutual funds as your IRA plan. Anyone with earned income can open and contribute. Different types. We have traditional IRAs, Roth IRAs, simplified employee pensions, IRA savings incentive match plan for employees, simple IRAs, withdrawal penalty of 10% if before age 59 and a half. Traditional IRA is funded with gross income, tax breaks for current year, taxes owed when funds are withdrawn, and for 2023, maximum individual contribution is $6,500. So I like the 401k plans better, but it kind of depends on what you are looking for. Lastly, we have the Roth IRA plans, and then it's a contribution from net income. No taxes paid on your investment gains. No taxes paid at withdrawal of funds. Contribution limits for 2023 are $6,500. You can contribute to a Roth IRA no matter how old you are, and it's recommended to start investing into a Roth IRA as young as possible. The younger you are, the more stocks can be added to the mutual fund you invest in, which means more money for you and more time to ride out the market lows. Roth IRAs allow compound interest without paying taxes at withdrawal, which is great. That's interest on interest, which is more money for you, and there's no taxes when you choose to withdraw it out. Beautiful. Lastly, I have some books and resources investing in retirement, so please pause it. Here are some books and some websites if you want to, and I will also link these in the description box below. And then lastly, we have the references that I base everything off of, and these are also some websites that you can go and look at, like SSA.gov, that's the Social Security website, and then also just some other ones. All right, guys, that's pretty much it. I know I kind of sped through this. I wanted to make sure you guys get this information. Pause it. Please leave any comments, questions, concerns, anything below. Look out for my workshops to come, and I hope to see everybody on our volunteer activity on February 24th. Okay, bye, guys.